Good morning, everyone. How's it going? It is half an hour before the market is set to open on Monday, December 4th. There wasn't any really big news that happened over the weekend. So, really, the last news item that we had was on Friday when Powell gave his speeches and he indicated that the Fed was prepared to raise hikes if necessary. And of course, the market's response to that was price in even a higher likelihood that the Fed would lower rates. So I'm not sure what that's all about. We can take a look right now and see if some reasoning came into the market and we reversed that decision today. So let's go ahead and take a look at our futures and our bonds. Let's take a look at TLT first. And it's hard to see, but there's an orange line indicating here in the pre-market that bonds are down a little bit. Let's go over here, TLT. So yes, you can see that we close right here and we're opening down here. So it does seem like maybe, at least in the trading action, it is coming down, and you can see right as we're speaking, it's coming down even lower. So that should indicate that we are pricing in less likelihood of a rate hike. If I go over here to my FedWatch tool, we can see in January, we still are pricing in a rate decrease, but you can see the percentage is down almost 2%. And then if we look in March, we're still way pricing in a high probability of, or higher probability of rate decreases than even just holding it steady. We've got a 0% chance of it being raised. So this did reduce, though. You can see that this 500, or I'm sorry, yes, this 500 to 525 basis point category did go down about 2%, and so did this 475 to 500. So not a lot, but at least a tiny bit of reason coming back into the bond market. So the bond market has been on this rally. It's been going up along this MA50, EMA 8 for a few weeks now. About maybe even more than a month, actually. Since the mid to late October, it's been on this run upwards. But as soon as the market starts to align itself with the Fed, then we will see that break down. That will create pressure on stocks, and we'll get a pretty heavy pullback if this bond market moves significantly. Now, why did I say the bond market moves to match the Fed? Well, the Fed has direct control of interest rates, at least on the short end. And the short end will, for the most part, dictate what the long end does. When the short end stops dictating what the long end does, and we have a situation where the short end stays the same or goes higher, and then the long end goes down, that's when we get those inverted yield curves that everyone loves to watch and use to predict oncoming recessions. So if the Fed keeps saying, no, we're going to keep rates steady, and we might even raise rates, and the bond market says, I don't believe you, and keeps on going up, so yields go down, then we get that inverted yield curve, which we already saw earlier. I think it was earlier this year, it might have been last year, which is a strong indicator of the possibility of upcoming recession. So that's definitely not something that we want to see. The Fed is not supposed to move and react to the market. Their only dictates and mandates are the employment numbers and the inflation numbers. So they're not going to care, or at least on the surface, they're not going to care about what markets are doing, except we do see that it does get politicized sometimes during presidential election years. And we do have that coming up in 2024. So maybe the Fed will react to a weakening stock market, but it's got to weaken pretty significantly. It's got to weaken so much that it looks like we're going into a bear market. And completely reverses what this new trend that we developed going upwards has been doing. So right now, that doesn't seem very likely at all. Let's see what futures are telling us. We'll start with the bonds. Bonds down, but not that much. Not that much, actually. We look at the NASDAQ, the S&P, and Dow. Those are going down quite a bit. And it looks like trending downwards from, let's take a look right here. Yeah, just in the last few minutes, you can see that, or I guess a little bit longer than that, really starting from about half an hour ago, a little less than half an hour ago, we really started to break down and trend downwards. So over here in the futures market, we definitely have downward basis. And based on the minute charts, that momentum is increasing into the open. So we definitely have downward pressure. These are significant. This is half a percentage point. This is about 70 basis points in the NASDAQ. And then the Dow is about a third of a percentage. So anytime we get to about a third, that starts to become significant and non-random. If we get to a half, then that's very significant and unlikely to recover during the day. So if I start half a percent down and I trade upwards all day long, it's hard for us to actually overcome that half percentage point, because the average movement of the S&P 500 on a given day is maybe about 0.5% to 1%. So 0.5% starts to become a little bit difficult to overcome, meaning that even if we trade upwards all day, there's still a very strong chance that we end up down relative to the previous day's close. Now, the NASDAQ is down 70 basis points. So that's going to be very difficult for the NASDAQ to overcome. And that gives us a very strong downward bias. What we do see, though, is still that separation between the Dow and the NASDAQ. So even though both of them are down, the NASDAQ is down double of what the Dow is down. And that is meaning that the Dow is still relatively strong to the NASDAQ. And there is this sector rotation. So, or at the very least, money is not leaving the Dow as fast as it's leaving the NASDAQ. So we still have that rotation going or in effect, and will probably continue into the end of the year, or at least until we get muted trading activity because of the holidays. Another thing that I want to look at is, now that we see that rotation happening and we see that there's some indications of weakness, at least starting out at the very beginning of December, which is if we get that pullback right in this first week of December, then that gives us a little bit of time, 1 to 2 weeks, to bounce back up and then maybe get a tiny bit of a rally in December. And if we're going to be positive in December, then it's going to happen after that pullback. We talked about last week how the S&P 500 was already up 9% just in November, and on the year it was up about 23%. And for December to be up also, we can't expect it to be up a lot. So it'll either be down against most people's expectations of the quote-unquote Santa Claus rally. But like I said, that Santa Claus rally may have happened already. If we include November into December as the end of year Santa Claus rally, then yes, even if we pull back, we're not going to pull back 9%, and it would still technically have been a Santa Claus rally. So that's something that not a lot of people are thinking about. So what I want to see is, if I have the equal weighted SPY, how is that performing related to the normal SPY? So if I look at RSP, equal weighted, you can see that it is very strong. This one did break out. This one looks like the diamonds. well, not quite as strong as the diamonds, but it looks very much like the diamonds instead of the S&P 500, which here is flat. Yes, we got that strong bar up here into resistance, but it's not that much higher than this high right here. So the RSP is definitely looking a lot stronger. We did hit this resistance point in the RSP as well. Then let's take a look. Let's do a comparison, direct comparison to the SPY. Okay. What we want to see is on a shorter term basis, actually, they are performing pretty much the exact same. The real difference was Friday. So everywhere else, you see how this basically lines up perfectly. Friday was a big difference. So today is going to be critical, and actually rest of the week is going to be critical in showing us whether or not we actually get a separation, because Friday was the beginning of a separation. Let me change this to a line chart. Probably see it a little bit better. And maybe get rid of these moving averages. Okay, so that blue line, that darker blue line, is the RSP, and the sea green line, unfortunately, I don't know how to change the colors. There we go. Let's do a red line. SPY is the red line. The blue line is the RSP, the equal weighted. And you can see on Friday we crossed over, where the RSP was significantly stronger, and before they're pretty much tracking each other. And the RSP suddenly became significantly stronger, crossed over the SPY. It was slightly underperforming before, and then it crossed over. And if that continues, then what that's saying is that those large cap stocks are weakening, and those Magnificent Seven stocks are weakening. And that will indicate even further this sector rotation that is happening. And then what we can do is we can compare the stocks that are outperforming in the RSP, and then, or grab the relatively strong stocks in the RSP, the leaders in the RSP, and those are the ones that we would start investing in into the end of the year. So this week is going to give us a lot of really important and relevant information. In terms of day trading today, we're definitely opening with a downward bias. That doesn't mean that we'll keep going down throughout the day. And actually, it means that with higher likelihood that we're going to at least trade towards that previous close. And then we don't know from there. Somewhere near the previous close, we'll probably stall out. We could stall out before we hit the previous close. And then once we have a bit of consolidation, we might choose a direction. It might continue higher, it might pull back downwards. But what we do know is, because there is such a strong downward momentum into the open, it is unlikely to continue through the entire session of today. We're not going to just go straight down the entire day unless something very terrible, a news item happens. There is going to be some sort of rest, some sort of pause, some sort of retracement, and the tendency is to retrace back pretty close to the close before we have a new decision point in that market and during the day. So if you're a day trader, just be careful about, watch out for an inflection point. It could be this purple line right here. It could be this previous low that we indicated 2 days ago, the previous low, or it could be some level in between. But those are the higher likelihood probabilities of a potential bounce and retracement. And if it's a strong downtrend, if this VWAP keeps going downwards, then it'll be just a retracement to either VWAP or some other level before it heads downwards or chops sideways. Otherwise, we'll get bounced back close to either this local high or the previous close before we need to evaluate and decide where the market might go from there. Okay, so be careful. We need to take a look at our economic calendar. So let's see what we've got going on. Monday, factory orders, even though it's marked green, will be somewhat significant. It gives us an idea of how much we're producing and how much we're manufacturing in the US, and that gives us an idea of demand. So that can be significant. Jobs, probably the employment situation would be more significant. So we get employment situation first Friday of every month. So that should, right here, the employment situation, that's going to be a major number. And that's about it. International trade in goods and services, maybe they'll give us an idea of GDP also, but we just got GDP last week. So this one might not be as significant this time around. So the two ends of the week are really where we're going to get most of the economic data focus. We've got, again, factory orders today, half an hour after the market opens, and then the employment situation on Friday. Let's just do a quick search for earnings this week. So it looks like we do have some. Actually, a good number, 90 of them, but probably most of them are small cap. Okay, so the only one of really significant size is Broadcom. Then we've got a handful of smaller. So AutoZone would probably be in, I call that really mid cap, still kind of low cap. And then we've got Dollar General, lower cap. Campbell's Soup, it's obviously in the S&P 500 and it's considered a large cap stock, but really at the 12 billion range, we are still kind of not in a huge, but you can see how quickly this drops off. Then we have smaller and smaller cap stocks. So very few of them are large cap stocks, 10 billion and above. Or in case DocuSign is probably still considered large cap, so 9.5 billion. Okay, so Broadcom, in terms of S&P 500, Broadcom, AutoZone, Dollar General, pretty light. Campbell's Soup, Smuckers. We've got some, but none of these are really going to indicate, they're not going to really move the entire market. Some of these might move their sector, but not really the entire market. So nothing too significant happening on the earnings front. So we're going to watch for these two news items at the front and the end of the week. We're starting out the first full trading week of December week. We'll see if it gets weaker, and if we get that pullback, if this RSP remains stronger than the SPY. And then I'm really going to be looking for, because of that sector rotation, I'm really going to be looking for a pullback or a stronger pullback in the QQQ rather than an SPY. Because if QQQ goes down and the Dow Jones continues to go up, then the S&P will be some average of that, maybe weighted more towards the QQQ side, but it'll be in between those two. So if I've got one moving very strongly upwards and one moving downwards, then my average is going to be somewhat flat. So the pullback that I'm really going to be looking for is in the QQQ, and that makes sense in the context of the Magnificent Seven stocks, because those are the ones that have really carried the market up the entire year. And those are the ones that money is going to come out of. We're going to take the profits at the end of the year and then put them into safer, less volatile stocks towards the end of the year. So it makes sense that QQQ, because all those Magnificent Seven stocks were tech related. So it makes sense that the QQQ would move downwards. Okay, so we're 10 minutes before the market opens. So I will leave you guys to prepare, and I'll see you in the aftermarket.